Hello and welcome to another episode of the Property Voice podcast. My name is Richard Brown, and as always, it's a pleasure to have you join me again on the show this week. Well, you might be able to see if you're watching on the video that I'm in a hotel room. I'm in Chicago in the USA. There's I don't know if you can see it behind me, there's a USA flag and a big freeway. That's the view from my hotel room. But yeah, doing some business here. Had a good couple of meetings, got a good couple of meetings yet to come. And then I'm going to head down to Dallas to be with my mastermind group, which is for the rest of the week. So trying to adjust to the time zone, want to get a recording done obviously for the podcast in the meantime. So that's what we're doing here today. So I've got some really exciting friends of Richard, if you like, podcast, video cast to share with you over the next couple of weeks. But today I really wanted to just talk about this little idea called the margin of safety. Now, if you study Warren Buffett or Benjamin Graham or Charlie Munger, those sorts of people, they come from the value investing perspective. And so one of the components of value in investing is what's called a margin of safety. And the strict definition of a margin of safety, as far as the value investors are concerned, people like Charlie Munger, is that there is a difference between what's called the intrinsic value or the book value of an asset and its market value. So we can apply this to property as well, can't we? And you might look at that as a discount, effectively. A discount between the market value and the purchase price, for example, that you're buying a property for. Now, we all want to buy below market value. It's something that's really spoken about quite a lot in the industry. And many people think that there isn't such a thing as below market value. Anyway, because if you bought it for below market value, then surely that's the market value. So there's a bit of around there, but essentially you can actually get valuations. Somebody else will give you the money that you think is a market value for the property, and indeed get a valuer to agree with them. Then of course you've got that margin of safety. But I wanted to expand on the concept a little bit of margin of safety and maybe how I see it. So it's all very well to look for below market value. And indeed, when we go into a property deal, a lot of people say you make your money when you buy. So look for the discount. Try and negotiate a discount when you're going in to buy a property. But I think what I also see is margin of safety in some slightly different ways as well. So let me give you an example. If I've got a rental property, I'm looking for a margin of safety in terms of the rental as well. So the net rental value. In other words, I'm not looking to just break even and look for capital growth to make my money, which is extremely speculative. I'm looking for a positive cash flow of a minimum amount of money. It's usually around about £200 a month for roughly a 100k property. That's the sort of figure I'm looking for. It's normally a minimum of £500 a month for an HMO. These figures sometimes we're able to beat. There can be some tricks of the game, if you like. If you self-manage, you can hide the fact that you're not paying a letting agent. But of course, you've still got your time that you should really be factoring in. But essentially, we're looking for this margin of safety. So it's the difference in the rent, all the costs, including your mortgage and including paying any fees, etc., and what's left at the end of it, and having a buffer. And indeed, we can take that a little stage further by, for example, fixing our interest rate. And the longer we can fix our interest rate, the longer we've got that margin of safety for, and we won't be hit by any sudden shocks. And that's really part of the purpose of the margin of safety as well. And similarly, if it's not a rental property, maybe it's a flip, whether it's a development to flip or a single property flip. Margin of safety in this case is the profit. It's the profit we're trying to make on the deal or on the project. What's known as developer's project. Profit, even if I can get my words right. So normally 20%, people say 20% on cost, total cost of doing the project is a minimum margin of safety or profit level that you should be taking. And there's a good reason for this. So often if you're in let's say a flip project, it's an average of 9 months. Some people tell you it's less, but if you want to really buy it, do the project up, do the property up even, and then resell it, find a buyer, and then go through the conveyancing process, invariably it's 8 or 9 months. Is how long it takes. Well, that's a reasonable period of time. Then, of course, if it's a development project where you're perhaps either converting or a new build, that timeline can push out 12, 18 to even 24 months depending on what's involved, especially if you have to go through, say, planning. So there's a long time that you've got to sit in the project. and in which case the margin of safety should actually increase depending on the length of the project or the length of time you need to wait. So I'd say 20% for a flip project, maybe a conversion project, and maybe a development project, maybe a little bit more, especially if you have to need to go and get planning permission. So it's that buffer, it's that difference. And the reason being that if prices should change, obviously if they should drop in that intervening period of time, then well, you can still get out without losing your shirt. And if we look through history, the largest single, depending on how you look at the figures, I guess, but the largest drop in any one year was around about 20%. It could have been slightly less, and it depends on what part of the country you're looking at. If we look at the last financial crisis and the property crash that followed, we probably see something like a 15 to 20% drop in a single year. If we extrapolate that over a couple of years, it could have been a little bit more actually. So it's good to build in that buffer, particularly if you've got a long duration in the deal. So there's kind of two ways of looking at it if you're renting the property or if you're undertaking some sort of development activity. Build that margin of safety. And then maybe some protections that you can put in place there. Certainly with the rental property, not so much with the development side of things. Then I actually look at this in a slightly different way as well. I look at this with my wider portfolio. So not just on an individual project by project basis, I also look at my wider portfolio. So I'm looking at the margin of safety across my entire portfolio. And that often involves me looking at the equity that's in my portfolio, the average loan to value, and then making sure that, if you like, I've got a healthy buffer in there. And included within those averages, you really should have some properties with a very low loan to value or even no loan to value, in other words, no debt on it. Now, this is obviously not necessarily possible when you're first starting out, so it's something to watch out for as you grow and try and get the debt paid down on maybe some properties, so you've got that buffer in case you should need it. So if we find ourselves in a recession or a property crash, we can actually manage ourselves through it, collecting rents with a margin of safety on the rentals, but also not falling foul of what they call the minimum loan to value threshold that some lenders would insist and is buried in their small print. In fact, if you read your mortgages, the terms and conditions, I know it's an exciting read, but if you were to read those, you might see some reference to a minimum loan to value or words to that effect. And what that means is that the bank is basically agreeing to give you the money, providing the loan to value remains consistent or doesn't fall below a certain watermark. And if it does fall below that watermark, they could ask you to put more money in to actually top up the deal, probably at the time when you don't actually have it. When you need it the most is when you don't have it. So during a recession, during a property crash, for example, might be times when you don't have money available. So it's good to have that margin of safety built into your portfolio as well. So that's another way of looking at margin of safety. And I guess the final way really I wanted to talk about in terms of margin of safety is not just with an individual property or our property portfolio, but our total assets and our total net worth as well. So as we expand and we grow, all the good financial advisors say that we should have diversification in our investment portfolio. So we shouldn't be 100% weighted in property, for example. And that's a good principle. And it's good to have some money in cash and maybe short-term liquid or highly liquid, easily liquidatable funds and assets as well. So stocks and shares you can usually sell quickly. For example, access to savings accounts with maybe 30 days, 90 days notice is still fairly liquid. Precious metals can usually be liquidated at fairly short notice, etc. These are just some examples. And margin of safety, again, in terms of your wider portfolio. So if you need to call upon the money at short notice for whatever reason, that you can do so. Some of it instantly and some of it in a fairly short period of time. So we've looked at three elements. We've looked at individual properties, we've looked at our property portfolio, and we're looking at our investment portfolio. So I'm looking at margin of safety in this wider context, probably a little bit wider perhaps than the strict definition that the likes of Charlie Munger, Benjamin Graham, and indeed Warren Buffett might be talking about. And I try to apply this principle really. And then the second thing that really pops out of this is, well, how much is enough? So I talked about a net cash flow on individual properties. I talked about a loan to value on a portfolio. I also talked about a minimum profit on, say, a flip deal or a buy to sell deal or a development deal, for example. And the same can be applied to our total investment portfolio as well. And I was having this conversation with a contact of mine the other day, and I don't want to reveal too many identities, but you can probably tell from the figures involved that the person was saying, I feel poor unless I haven't got a certain amount of money in the bank, cash in the bank. And that was quite a substantial amount of money, I have to tell you. But then I asked the question, well, that's a very round figure. It was a round figure. I asked the question, well, how did you arrive at that figure? I mean, it makes a lot of sense that you've got money that you can call upon in time of need, but how did you arrive at the specific figure? And it was more like a comfort level. Well, it feels about right. And then we talked about the concept of margin of safety in this context, and we worked out that the sum of money that she had set aside was around about 15% of her total net worth. So in other words, she had 15% of her total net worth set aside in literally cash. I guess if I didn't explore this when we talked, but I guess if she had other highly liquid assets, it probably is a bit more than 15%. And then we had a discussion about risk profiles and how much was the right level. And I think the right level is probably somewhere between 10 and 20%. 10 and 20% of your portfolio in cash or highly liquid or relatively fast liquidatable assets to be comfortable and to be a buffer in times of shock or in times of need. We also went on to talk about the fact that someone that they knew who had zero in cash or highly liquid assets. Property is not a highly liquid asset, just to make the point. So if we're talking about other things here, stocks and shares, cryptocurrency, precious metals, savings on short notice call out, obviously cash, premium bonds, those sorts of things are relatively highly liquid assets to have at our disposal. Property isn't. It can take quite a long time to liquidate a property, whether you want to finance it or whether you want to sell it on. I'm sure you all well know that. So I'm talking about something here in terms of liquidatable assets. So 0% is quite high risk. So I wouldn't advocate that. Of course, when we've got £10,000, that's all we have to have available. It's hard to separate that into buckets of £1,000 and spread it across 10 different asset classes. It's kind of difficult. So I think you tend to concentrate more when you've got less funds available. And but as we get more funds available and we build up our portfolio and our net worth, it's wise to diversify, but it's also wise to have a certain amount of money set aside for a rainy day. And that fund should flex depending on your risk profile. Now, somewhere between 10 and 20% is probably a normal level. I think if you're super risk averse, you might want more than 20%. And if you're flying by the seat of your pants and you think it's all going to go swimming well, you might be able to tolerate less than 10%. Whether it's wise to do so is a different point. But about risk tolerance, you might be able to tolerate less than 10% available in liquid form. So for me, it's between 10 and 15%. For my contact, it was 15% plus, more like 20 probably, if we were to include other, highly I can't say this phrase, can I? Highly liquidatable assets. So there's a difference there, and obviously that one other person had zero. I just think the right thing to do is have a sum of money that's set aside that you could utilise under certain circumstances. So that's really the point I wanted to make about margin of safety, and hopefully that gives a slightly different spin on it than you might have heard or seen through some of the literature on the topic as well. So that's that. Now, one thing that's been brought to my attention on a totally different topic before I close off today is, you may remember I had James Davis, who is the MD founder of UPAD, on as a guest on the podcast during the PropTech series recently. Well, sadly, UPAD are no more. They went into administration recently, which is rather sad. I do actually think that there is quite a lot of different PropTech providers in certain quarters, and maybe the level of growth of online serving providers in the lettings and estate agent market is too many for the amount of businesses actually available, certainly today. And I don't really know what happened with UPAD. I haven't looked into the detail, but unfortunately there are no more. Now I'm just going to make a quick look up so I get the right reference. The lettingsandproperty.com is another provider in this space who've been relatively well established, and they've got an offer at the moment. So if you've been affected by the UPAD demise and you were using them, then lettingsandproperty.com have got an offer I'll put links into the show notes if that's of interest to you. Obviously, you may have heard of UPAD as a result of the Property Voice podcast, so I think it's important to share, well, is there an alternative that perhaps you could utilise? And I think they've got a special offer on for people who might have been affected by the UPAD device. So that's just a little bit of extra support for you in a slightly different area. So it's a bit sad to see that situation with UPAD and James, obviously. But if you've been affected, perhaps have a look at the show notes and maybe there's a way out for you. So there we go. I'm over in the States, as you can probably tell, trying to struggle adjusting to the time zone. I'm meeting a number of people in Chicago, and I actually had somebody drive over to meet me all the way from Toledo. It's a 4-hour each way drive, so that was great commitment from that individual to come and meet me. Lots of good conversations, business opportunities being crammed into the agenda whilst I'm here in Chicago. I'm going to drop down to Dallas for the next few days, and that's going to be great. By the way, if you're looking for me the next few days and you need anything, it's going to be pretty full on, so expect a slow response. That's going to be great. That's going to be an opportunity to work on the business and not in the business, and get some good feedback from some heavy hitting people who will be in that particular room. So there we go. So on tour, I suppose, the Property Voice podcast. Just still wanted to get a share out with you this week. Hopefully that's been valuable with the margin of safety share. And the show notes are going to be over at the website, thepropertyvoice.net. Of course, if you want to talk about anything from today's show, you can always email me, podcast@thepropertyvoice.net. You can also call me, and it will find me most of the time, 0208 144 5895, UK number, and it'll chase me down and find me wherever I am, even in the States. So give me a call or drop me an email if there's something you want to talk about that's interested you and intrigued you from the podcast, whether it's today's show or another show. I'd be happy to hear from you. I love talking to listeners and people who are planning forward on their journey, so it'd be great to hear from you. Meanwhile, as always, the show notes are going to be over the website, thepropertyvoice.net.